What's up, heretics? My name is Joe Brown. This is the Heresy Financial Show, and today we just got a record-breaking inflation number, 9.1% year over year for June. Biggest inflation that, again, we've seen in decades. Like I've been saying for months, every month when the new inflation numbers come out, we break new records, and now this is the highest reading so far on this current inflation run. But I'm going to show you something that is even worse than that 9.1% number, because the year over year 9.1% number is not the number that we should be paying attention to. I'm going to show you the real inflation number month over month and why that matters way more. Ready? Let's dive in. All right, guys, so take a look here. Inflation rose 9.1% in June. Obviously, that was higher than expectations, and it's higher than the last couple of months. And so we are seeing inflation pressures intensify. So what does this mean? Well, number one, it could mean that the Federal Reserve will opt for an even more aggressive rate hike. We are now seeing futures showing a 1 in 2 chance of a supersized move in July from the Federal Reserve. So normally, historically over the last few decades, they raise rates by 0.25% at a time. So far in this rate hiking cycle, they started there, then they went to 50 basis points, and then they went to 75 basis points, which was considered a monstrous move for the Federal Reserve. And just in case you're not aware, a basis point is 1% of 1%. And so if you move 100 basis points, that equals 1%. So if you take interest rates from 1% to 2%, that's a 100 basis point move. 1% move. If you do it by 50 basis points, that's 0.5%. And basis points are sometimes also, they show up as BPS, and sometimes it's just pronounced BIPS. All the same thing, 1% of 1%. So the Federal Reserve could raise rates by 1%. Again, this would be the biggest rate hike in a very long time. I'm not sure if they've ever gone up by 1% at a time, but 75 basis points was also huge historically. Now the question is why? Because to be honest, 8% inflation versus 9% inflation isn't that much of a difference. It's not like we got a 12%, 15% reading. Although you know just as well as I do, the real inflation is far higher than this, but all that matters right now is looking at what the monetary policy changes will be based off the official numbers. So take a look with me at this. This is the month over month numbers. This is what matters most. So we've got January month over month. So just in case you're not aware, June inflation at 9.1%. That means that prices from last June to this June went up 9.1%. That's a year over year number. That's the one that most people look at. Month over month numbers are different. Month over month numbers look at June's prices versus May's prices. So if we look since January, month over month inflation, this is a seasonal thing, ebbs and flows based on the seasons, but January was 0.5%, then 0.8%, then 1.2%, then April 0.3%, May was 1%, and now June was 1.3%. Now, if we zoom out just a tad bit, we can see this month over month trend is accelerating. This is the big deal, because while you look at something from a year ago, you can say, okay, well, prices were down because of this, and so inflation looks elevated because of this. And so you can start to look at all of the different factors that have happened over a year and explain away a little bit of the rise in inflation. But the month over month numbers show the immediate trends here. And the month over month numbers clearly show that the tightening that the Federal Reserve has engaged in so far have not broken the trend. Since the bottom in 2020, we've had this accelerating month over month inflation where, yes, it's gone up and down, but you can clearly see the trend here is going up. And so this means that every month the inflation numbers are getting bigger. So it doesn't matter if we look a year ago and say, oh, well, prices were down in this area because of this. Prices were, there's a lot that has changed with supply chains and all that. No, the month over month numbers show what the trend really is, because you're looking at every single month, not just compared to the year ago. And so when you look at what the Federal Reserve has done with monetary policy, we can see that it has not had an impact yet on slowing down inflation. Inflation has continued to not only persist, but accelerate even despite the monetary tightening, the raising of the rates and letting assets bleed off their balance sheet. So I want to show you why with this illustration. This is how monetary policy impacts an economy. All right, so the first thing it does is it hits assets. Wow, I can't spell. The second thing that it does is it hits goods and services. The third thing that it does is it hits wages. So when you talk about inflation, we're looking at the prices of goods and services. So the question is, what is the time delay from it hitting asset prices to it hitting goods and services? Well, the very real thing about this that nobody denies is the time delay. Because even the Federal Reserve back in 2018, they were talking about this when they were talking about tightening and then easing again. They were saying, hey, look, monetary policy takes at least a year to hit the economy. It's a very well-known fact. Most people just don't realize it though, because the first thing that it does is it hits assets. And so what we see is we see the stock market, we see asset prices start to fall. So everybody assumes that monetary policy hits the economy immediately. So we're seeing the Federal Reserve raise rates. We're seeing the Federal Reserve let assets bleed off of their balance sheet, stop their accommodative monetary policy. And as a result, we're immediately seeing asset prices take a hit. But guess what? That's asset prices. That's not the economy. And so what we are really looking at is the price of goods and services. And so far, all we're seeing is the prices of goods and services go up. So when we look at how much longer inflation will stick around for, we have to ask ourselves, when did the tightening start? And the tightening started this year. So we will probably continue to have at least a few more months of goods and services prices going up, because it takes an entire year between when tightening starts and we see it show up in assets and by the time it hits goods and services. This is a 1-year time delay here, at least on average, when you look back throughout history at when they start tightening or easing and when it hits the economy, which in this case is going to be your goods and your services. And so since we're looking at an entire year, we're probably looking at closer to November, December, January by the time that their tightening takes effect. Why is this a problem? Well, it's a problem because if we look back at the month over month inflation rate, inflation is continuing upwards. And then if we look at what that means the Federal Reserve is doing when they recently said, we now know how little we know about how inflation works, the question is what kind of recession we are going to get. They changed to a 75 basis point increase last month, and now it's expected there's a 50% chance, 1 in 2 chance of a 100 basis point move next time they make a change to interest rates, which means they're completely ignoring the fact that there is a 1-year delay between when it hits asset prices and when it hits goods and services. And so all they're doing is front loading all of the negative deflationary effects that are going to hit goods and services at the end of this year, simply because we continue to see those prices go up. They're ignoring the time delay. And so by the time all of these deflationary forces start to hit goods and services, the economy, it's going to have like a year of deflationary forces pent up against it. And so really what we're looking at is they're ignoring these economic principles. They're loading up these deflationary forces, just completely either forgetting or ignoring the fact that there's this time delay. So we're going to get these asset prices, more pain in asset prices along the way, because those respond immediately, because you can, with assets, you can buy and sell with expectations of what monetary policy is doing. So asset prices respond immediately. So we're looking at more pain in asset prices. Meanwhile, more pain in goods and services as they're still feeling the inflation from last year's monetary policy, which was easy. And then by the time the end of this year comes about, when all of those deflationary forces start to work their way through to the economy, goods and services, by that time, we're already going to have a bunch of asset price deflation. It's going to hit the economy all at once. And then we're going to have this massive deflationary death spiral start. And By the time then they say, okay, we've got control on inflation now, well, now you've got a year of deflationary forces pent up. And so they're going to have to flip the other way, and they're not going to be able to stop the price fall. It's going to be a deflationary death spiral that they're going to be trying to catch like a falling knife, and they're not going to be able to do it without completely, collapsing the currency there. So they're building a real deflationary trap for themselves. And one final note here, just in case you don't know why I'm saying that there's a year delay, what the mechanism is there. Basically, you have monetary policy that really all it does, whether it's rates or assets or anything like that, it's either increasing the amount of money in the system or decreasing the amount of money in the system. Through a variety of mechanisms, whether that's bank lending or asset purchases, quantitative easing, debt monetization, anything like that, all of these tools are either increasing the money supply or decreasing the money supply. When that happens, it's a direct effect on somebody's bank account. And so the first place it affects is asset prices, right? Because it will increase the perceived value of asset prices, so more buying will take place, or decreases the perceived value of assets, so more selling will take place. That will either increase or decrease the amount of money that hits somebody's bank account, whether it's a person's bank account or a corporation's bank account. When that happens, you look at maybe new investments that have taken place. All that does is put money in somebody else's bank account. So somebody gets their check, they spend it at a store, that goes into the store's bank account, and then they say, hey, we're going to reinvest that by buying more products, reinvesting in more inventory, we're going to expand our infrastructure, we're going to build more factories. Whatever they do with that money, every time money is spent, it hits somebody else's bank account, and eventually it works its way into the average daily person's bank account, which then eventually works its way into buying goods and services. That process takes a long time for all that new money to work its way throughout the economy. That's the inflationary force. Deflation is the same thing. For that deflationary force to work its way throughout the economy, there is a long lag there before it works its way through. And so that's the mechanism by which it takes roughly a year for these things to take place. And that's why we're seeing all these deflationary moves from the Fed getting tighter and tighter and tighter, but we're still seeing goods and services prices go up while asset prices are dropping because they respond immediately. Goods and services are going up because they respond from what happened a year ago. And so we still probably have a couple of months of asset prices dropping, more pain there, goods and services prices going up, so more pain there until it hits all at once and these deflationary forces start to hit with some crazy impact. And then at that point, I would expect some contagion, some systemic risk, and the Federal Reserve to at least back off a little bit and probably reverse course to try and bail out the system. Let me know if that makes sense. Really appreciate you guys. Thanks so much for watching. Have a great day.